Welcome to the Deep Dive. We're here to cut through the noise and get to the core insights. Today, we're diving deep, really deep, into the world of GCC family offices. Now, if you're a global investor, a capital manager, well, you need to understand the space. These aren't just your average wealth managers. Think regional powerhouses. We're talking about entities managing collectively trillions of dollars. And the big shift, they're moving beyond just passive holdings. Our focus today is drilling down into their playbook for these massive multi-billion-dollar mega deals, the kind of investments in infrastructure, tech, real estate that literally reshape the region. So our mission here is to unpack how they actually source, vet, and execute these deals, how they turn that legacy wealth into, well, active engines of regional power. We've got some compelling analysis here, global capital flows, financial innovation. It paints a picture of, frankly, extreme strategic agility.
It's fascinating, isn't it? Because the whole mandate, the whole approach has fundamentally changed. Historically, these offices, they were more reactive. They waited for the big banks to call for those invitations. Not anymore. Now they're engineering access. They're using digital precision, strategic networks, basically dictating capital flow. We're seeing this framed, quite aptly, I think, as the rise of tokenized cross-border wealth engines. They're really setting a new standard for how global assets get managed, how they get traded. It's a mechanical shift almost.
Okay, right. Let's unpack that. Engineering access. When we're talking deals in the billions deals that redefine a skyline or a whole sector, how do these, private offices even find them? I mean, it can't just be responding to public tenders, surely. It feels like it has to start somewhere much more exclusive.
That's exactly it. That's the core of the strategy. The deal flow itself is highly protected. Access isn't just given. It's a byproduct of really meticulous relationship mapping. It tends to flow through these private syndication channels, advisors who are adjacent to the sovereign wealth funds, people who control that pre-market deal flow. To even be relevant, you have to position yourself where the capital is already essentially mandated to go in the future.
Which means, practically speaking,
it means aligning with regional development priorities. Seriously aligning. Think about the capital pouring into Riyadh's giga-projects. NEOM, Qiddiya, huge. Or the massive infrastructure plays around Dubai's logistics hubs, Abu Dhabi's push into renewables. That's where the gravity is.
So it's not just having deep pockets anymore. It's about proactively steering that capital, aligning it with national ambition, that level of cooperation. That must unlock some serious doors, right?
Well, absolutely. It really does. The critical leverage point for these family offices is precisely that alignment with national diversification agendas. Think Saudi Vision 2030, primarily. That alignment is the key. It unlocks priority access to what our sources are calling club deals. And in these deals, the families are co-investing right alongside the sovereign wealth funds. They're often securing, say, 15 to 25% equity stakes in assets that are truly foundational to the region's economic future.
The sheer pace of this shift, it's just incredible. And it seems driven by some really ambitious targets. I read that non-oil sectors across the GCC are aiming for, a 65% contribution to GDP by 2030? That's massive. That kind of financial imperative, it forces a pivot, doesn't it, from passive holdings to these direct, huge investments in things like smart cities, digital infrastructure, just have to move faster.
And that speed, it's being powered by digital transformation. This isn't just theory anymore. It's practical finance innovation happening right now. Our source material points to a really remarkable number, a 28% year-over-year increase in tokenized real estate participation, specifically by GCC families.
Hold on, 28% year-over-year in tokenization. That's a huge acceleration. For those of us maybe more used to traditional asset management, maybe unpack that a bit. Why fractionalize a huge, say, $500 million physical asset? Doesn't that add complexity, maybe regulatory risk?
It seems counterintuitive, maybe, but it's necessary because those traditional big infrastructure assets, they're fundamentally illiquid, stuck capital. Tokenization directly attacks that illiquidity problem. You've got platforms now taking assets valued at $500 million or more, maybe an entire logistics park, like you said, and they divide ownership into compliant, liquid digital tokens on a blockchain. It essentially makes the asset tradable, almost like shares in a public company, but for a private development. And crucially, this is often happening within specific, compliant regional zones designed for this. Platforms like Aland, for instance, are becoming pretty integral. They do more than just screen deals. They offer AI-powered deal sourcing, yes, but critically, they use blockchain to verify the asset's provenance, its ownership structure, transparency.
Right. So if you're managing complex family wealth, maybe with strict governance rules passed down through generations, that transparent ledger technology actually helps ensure compliance. And it does that while speeding up the whole process of committing capital.
Exactly. That's the double benefit. Yeah. The net outcome for anyone watching this space is staggering efficiency. This tech is slashing typical sourcing and verification timelines. We're talking often from several months of traditional due diligence down to maybe just weeks. That speed is their competitive advantage in this arena.
Okay, so sourced in weeks, not months. But then comes the vetting. Our sources talk about needing forensic rigor layered with reputational intelligence. It sounds intense. They detail a specific three-phase protocol, right? And it goes way beyond just checking the financials.
It absolutely has to. I mean, think about the lifespan of some of these investments, 20, maybe 30 years. So phase one is foundational. Macroeconomic alignment. They're rigorously stress testing any potential deal against immediate global signals. This means looking beyond just regional stability. They're factoring in external things like, say, U.S. inflation signals or the stability of local currency pegs.
Can you give us a concrete example? How does that stress testing play out in practice?
Sure. Let's say they see rising consumer price index figures globally, particularly in key construction inputs, steel, maybe specialty components. That immediately flags potential margin compression down the line on the construction side of the project. So the deal structure itself must incorporate sophisticated hedging strategies right from the outset. Often that involves using digital asset classes, actually, to protect that profit margin before a single contract is signed.
Wow, okay. That's seriously proactive risk management. So once the macro factors align, what's the next step? The ground game. That brings us to phase two, I think. Operational integrity.
Operational integrity, yeah, that's the real boots on the ground work. It requires deploying these highly specialized, often dedicated teams. Their job is to audit incredibly complex, often multinational supply chains, and also the overall corporate governance structure of the actual project entity itself. And this is where the digital side adds another layer. For these newer tokenized developments, you can't just rely on a traditional paper trail audit anymore. They must conduct very specific smart contract audits. Why? To eliminate counterparty risk that might be baked into the digital agreements themselves. I mean, if the blockchain contract governs payments, ownership transfers, then the contract code is the operational integrity, in a way.
It sounds like a really integrated diligence process then. Financial teams, technical teams, legal, all have to be in lockstep. Okay, that brings us to phase three, brand resonance. Now, this might sound like the soft metric, the fuzzy stuff, but the analysis suggests it's anything but.
Oh, it's absolutely not soft anymore. It's become a quantifiable financial factor. Seriously. They actively measure the value of what they call brand uplift. They look for mega deals with a cause-related angle projects explicitly tied to education, sustainability, social good, something that aligns with the family's legacy and values. According to some pretty sophisticated analytics, these specific investments boost the family office's sentiment scores among key stakeholders, investors, regulators, the public, by somewhere between 18 and 22%. That consensus, that positive sentiment, it turns stakeholders into long-term advocates, which in turn enhances the stability and even the perceived financial value of the underlying investment.
That measurable sentiment boost, linking it directly to value, that's absolutely key. Okay, let's make this really concrete. Let's look at a real-world example of this whole model in action. And crucially, let's talk about liquidity. Because liquidity is usually the bottleneck in these huge long-term infrastructure plays, especially when speed is critical. We reviewed a case study, right? A UAE-based family office that seemed to execute this perfectly. They tokenized a $300 million logistics hub right next to the Jebel Ali port. And using that distributed ledger transparency we talked about, they managed to source co-investors from 3 different continents, all vetted super efficiently, apparently in just weeks.
That's the one. And here's the really critical detail, linking back to phase 3. They integrated a workforce development initiative directly into the project's cause structure, this social impact component. It wasn't just some PR footnote. The data showed it elevated brand loyalty among their institutional partners by a measurable 20%. So when the project's overall ROI exceeded 24% in its first year, which is impressive in itself, they actually calculated that a massive 50% of that enhanced return was directly attributable to the heightened investor confidence generated by that social impact integration.
60% of the upside ROI. Wow. That completely reframes social impact. It's not an expense line item. It's a core financial driver in this model. But okay, back to speed for a second. You mentioned competition for these exclusive club deals is, well, cutthroat. How do they actually handle deploying the capital needed when, as you said, timing windows might slam shut in 72 hours? traditional banking rails. They just can't move hundreds of millions that fast across borders, can they?
No, they really can't. And that's the point. They often don't use traditional banking rails for that final, rapid deployment. This is where proprietary innovations like Gold come into play. And let's be clear, this isn't speculative crypto. We're talking about a stable digital currency fully backed by ethically sourced physical gold. Tokenizing gold like this does two things. It enables instant hedging against volatility, and critically, it allows for microcapital deployment, sending precise amounts directly into various project tranches almost instantaneously. This effectively bypasses the significant regulatory friction and the settlement delays you always get with cross-border correspondent banking. And that capability, it is absolutely critical for actually winning those ultra-competitive billion-dollar bids that have those incredibly tight, maybe 72-hour closing windows.
So by using this kind of digital asset model, they're essentially creating their own faster, more efficient financial rails, bypassing the global bottlenecks.
Precisely. The analysis suggests these families can recycle their capital something like 40% faster than if they relied solely on traditional banking systems. That preserved agility, that speed, that's the definitive competitive edge. It's what allows them to consistently win these high-stakes mega deals when others simply can't move fast enough.
Right. So let's synthesize this. What does this all mean for the global economy, and maybe more importantly for you listening as an investor or advisor? GCC family offices are deploying a really sophisticated, multi-layered strategy here. It's not just one thing. They're leveraging national visions, they're fully embracing tech innovation, things like AI-powered screening, fractional tokenization, and they're applying this incredibly strict three-phase vetting protocol we discussed. And the result of all this, it allows them to move capital much faster, to drastically mitigate project risk over the long term, and crucially, to build genuine brand equity and stakeholder advocacy, which translates directly into hard returns through that cause alignment.
And just to underline that point, the non-traditional ROI, the return coming from social impact integration, it's no longer abstract or nice to have. It's a measurable financial factor. We saw potentially 60% of enhanced performance in one major deal attributed to it. They've effectively turned good governance and cause alignment into quantifiable financial upside. So maybe we'll leave you with this final thought, something to mull over. If the ability to recycle capital 40% faster, using tools like tokenized gold, is now becoming essential, maybe even the requirement for winning billion-dollar deals with these compressed 72-hour closing windows. Well, how quickly will traditional global investment banking need to adopt very similar digital hedging and rapid deployment technologies just to stay competitive in financing major global infrastructure? That's the challenge, isn't it? The speed of wealth in the GCC is starting to dictate the pace for everyone else.
A powerful thought to end on. Thanks for diving deep with us today. We'll catch you next time.